Before I start the main presentation, I should probably mention that down the years, Legal & General and Schroders have worked together on a number of property ventures, whether that's developments, collaborating on joint ventures, and also co-investing in the same products. And it's with that spirit that we're talking to you today. So in terms of our agenda for today, what we'd like to do is remind you why people invest in property. We're also going to tell you how you can access it. I'm going to give you an overview of the property market as we see it today. We're then both going to talk about some of the challenges facing investors and the developing themes we see in the market, before looking at ways of capturing growth, including some alternative and emerging markets. And finally, we'll get our crystal balls out and look ahead to the future. So firstly, a reminder why people invest in property. The first point is diversification. Property does behave differently to bonds and equities in people's portfolios. That's been proven over time, and that's a key attraction of property. Also, over the longer term, rental growth from property and growth in income from property has outstripped wage inflation. So very important for people like you looking at your liabilities for the future. Also, property gives you opportunities for adding value through active management. It's a real asset class, it's not homogenous, it does behave differently, and we think that skilled managers can add value, whether that's through a change of planning, through development, through extensions or new lettings. And finally, and also very importantly at the moment, a really strong, favourable point about property is its income return. At the moment, property is yielding about 6.3%, which is very strong compared to most other asset classes. So we've talked about why property. How to access it? There are 5 main routes into property. Firstly, you can buy direct property, so the physical bricks and mortar buildings. The downside of that is that you have to be quite a big investor to get diversification. And our usual rule of thumb is that about 200 million is about the minimum you need to put into property to get diversification. If you're a smaller investor, you can look at pooled structures. That does give you this diversification. And I suppose the next variation of that is the fund-to-fund route, the area I work in. And the principal attraction here is you're investing in a number of funds. So for something like a £30 million investment, you get exposure to about £10 billion of underlying property. It's not just diversification of assets, it's also different managers and different strategies. Derivatives are a new and emerging area for the property market. It's still early days, but obviously this is a synthetic way of getting exposure to property. And finally, people have invested in real estate investment trusts, effectively listed property companies. The attraction of these is that they're liquid, which obviously is one of the downsides of commercial property. But the downside also is that they're more closely correlated to equities in terms of performance. So it may not give you this pure property return you're looking for. Of course, some investors use all 5 of these different routes into property. So we've talked about how to access it, and the final slide for me in this section just looks at where the market is today. What I'm showing on this slide is the 25-year total annual rolling returns from property. That's shown by the solid blue line. The point to make here is that this is the average return for property, and of course there are going to be variations in different regions and different sectors. And what you can see with that dark blue line is that it has been fairly volatile. There have been ups and downs, and the shading of the bars really shows you what's driving that return. There are 3 main aspects. So income return, effectively the rent that the tenant will pay us as landlords. That's shown by the grey bars. And what you can see is that that's been positive throughout the whole period, and it tends to range between about 5 to 8% per annum. The next feature is rental value growth. What we see here is that normally in strong economic conditions, positive markets, companies are profitable, they can afford to pay more rent, there's competition between occupiers, and what that does is create rental value growth. And the way we capture that as managers is either through rent reviews or through new lettings. The final component, shown in the green, is yield impact. And what this effectively means is the price that people are prepared to pay for property. So in various market conditions, people will pay keener or weaker prices. And what you can see is that this is by far the most volatile part of the property return. What we can see from the early 2000s onwards was that the green shading is obviously quite strong. Total returns from property peaked at about 20% per annum in the mid-2000s. Of course, we then had the global recession. Property values fell by about 44%, and most of that was coming through from this yield impact. What we've seen since then is quite a strong bounce back. Property values have risen by about 16% from the trough. But where we are today, looking at the far right-hand side of the chart, is that in this low economic growth environment, we're seeing virtually no positive or negative impact from rental value growth in average. We're seeing this strong income return of about 6.3% per annum at the moment. And what we're seeing is that capital values are just starting to come off, with this yield impact turning slightly negative.
Okay, so we've seen that income is dominating average returns at the moment. Obviously, capital values here trending down, as Graham says. But to really understand where the growth opportunities are, and that's really the topic of today, it's important to drill down behind these numbers so you can see really what's affecting the markets and navigate through them. So let's just start off with breaking property down into two component parts, first of all, prime and secondary. Now, this chart shows you where the yields are for both those categories of property. And what you can clearly see is there's a story emerging here that prime real estate, that's the really good locations, the good income streams, and good quality tenants, is reasonably stable at the moment. And there's some good reasons for that I'll come along to in a minute. Now, the true story is happening and emerging in the market where poorer quality property, more difficult locations, shorter lease terms, are actually falling in value. So you can see here from the orange line how secondary yields are tracking upwards. And obviously that gap is really quite a high stage now, and probably the largest gap we've seen for some considerable period. And for a fund manager such as myself, it's a great opportunity because there are strategies that are very successful in delivering capital growth by bringing that gap down again. And I'll come on to a few examples of that in a short while. Now, it's obviously a dotty picture, so just let your eyes settle for a moment. I'll explain what the chart's saying here because we're going to drill down into what the sectors are doing in the property market, just to give you some clues around that. Now, the horizontal axis of income return is articulating where various segments of the property market are delivering varying different levels of income return at the moment, and the vertical axis is giving you the breakdown of capital value change by different segment. So let's just take all property for a moment. These figures are running from the beginning of this year up until the end of July, so you've got roughly 7 months worth of data in there. And so for example, on the income side of things, all property delivering just shy of 3.5% so far on income return, roughly getting to the figure that Graham referred to earlier by the end of the year of 6.5. Now, on the capital side, it further emphasizes what we're talking about in terms of values trending backwards. You can see from the chart, minus 3% capital value falls so far this year. And as we saw earlier, the mainstay of that occurring within the secondary properties. So we'll sort of move around the chart a little bit more now. Just focusing on income return, first of all, you can see how the income return is being dominated at the larger end by, let's see if this one works. Here we go. Regional offices outside London, M25, up and down the country. Quite high yielding segment where values have obviously fallen, but reflecting 4+% in terms of income return to date. Now, when you contrast that to central London offices, you can see here a lot lower in terms of income return, just over 2.5% or so from there. But as you'll probably notice, and it won't come as any shock, the capital value side is where the story is here. And all of these segments suffering on the capital value loss side, in spite of some positive income return. Now, the exceptions being central London, which I'll come to in a minute, and also the alternatives. And alternatives here, we're talking about leisure, talking about healthcare, student accommodation, farmland. And that's been reasonably resilient in capital value terms and also delivering quite a high income return too. Okay, this is quite a busy slide in terms of colours again, so apologies, but I think it tells quite a nice story, because once you get to start to look behind what the capital value movements are doing, it's important to understand who the buyers and sellers are in the market, and that gives me an opportunity to navigate around some of the weight of money issues that drives property pricing. So the immediate observation on the chart here is that the green bars reflecting the overseas investors are particularly dominant. And this is last 2 years of quarterly data, but the theme is a useful one. Overseas investors are particularly active and have been really dominant so far over this year. And that's really been about their motivations to find real estate that gives them diversification qualities of currency. It'll give them safe haven status from political instability. And particularly all this money is, and you've probably read about it in the papers, all focused around central London. And central London's got this new sort of badge of being Great Britzeland, because it actually it's attracting a lot of sort of gold status money, which is really looking for trophy assets and those prime assets. So if we link it back to the prime yields chart that I showed you earlier, that's really part of the explanation as to why they're reasonably stable yields at the moment. Now, let's have a look at the sellers for a moment. There's two things I want to bring out here. Firstly, UK institutions becoming net sellers at the moment of UK real estate, and that's really a reflection of some of the life funds down weighting and offsetting some of the pension fund investment into the sector. Now, the interesting story here on this chart is actually the orange parts of these bars on the negative side, and you'll see there from the financial institutions and banks. Now, clearly we know a lot about banks, we know a lot about what they have at the moment in terms of their bloated real estate books, and I'm going to come on to talk about that in a moment. But here you can see a consistent sell down over the last 2 years. It's ebbed and flowed, and I suspect after the summer that we're going to start to see more of that transpiring through the market again as we go through the remainder of this year. So there's a lot of themes emerging. Let me just finish off a market snapshot here by just looking at property yields in the context of equities and bonds, just to put that in context. The dotted lines here on the chart are the long run averages with each of the two other asset classes. So the difference between property yields and, here we are, bond yields, you should ordinarily expect about a 2% difference. And with equities, you should be expecting about a 3% difference. Now, at the moment, the current charting line with the orange in equities, it's about that sort of trend. We're about on the mark, and you would infer that that would also mean that compared with equities, property is reasonably fair valued at the moment. Now, the distinction, obviously, and you quickly have noted it, this is the property yields compared with bond yields at the moment, 5% difference, way above the long-term average of 2%. And we would infer from that that property looks to be underpriced in that context at the moment. And it's obviously quite a big motivation for quite a number of the property investors, yourselves as pension schemes amongst them, that are seeing the asset class as quite a popular strategy at the moment. So just to conclude a bit of the market snapshot for a moment, what we've seen is clearly income returns dominating total returns at the moment. We've seen capital values falling in the secondary markets. We've seen the overseas investors really quite dominant and particularly focused on central London. And we've seen a property market that looks to be underpriced when it's compared with bonds, but on a par with equity pricing. So Graham and I are going to, over the next period, just going to talk you through some of the challenges as we see them to capturing growth. And obviously, as a theme of the conference, there's quite a few for property, and we've sort of tried to narrow it down between us to our top 3. So let me just kick off, and at the risk of being lynched for putting up this heat map because you're all from different areas of the country, let me just sort of explain what the chart is doing, and then I'll come back to talk about some of the background to it. This is some work that we did with Oxford Economics, and really produces a recovery traffic light map across the UK for different areas of it. Now, it's not a growth map. That should be clear right at the start. It's actually a map that tracks a couple of series that are quite influential in recovery and bounce backs. And these really look at locations across the country to determine the fundamental resilience of each location. So for a fund manager, and I'm buying and selling in the market consistently, I want to know which are the areas that have good future bounce back following really the difficulties that we're experiencing at the moment from an economy which is really stuck in first gear. And we can see that economy being stuck in first gear for quite a while, so we need some strategies to get around that. We're also obviously in a government austerity budget phase, and that austerity budget, the worst since World War II, has really some dramatic impacts upon the abilities of locations to really start to grow again. So private sector needs to do much of the heavy lifting, because clearly government won't be able to, and private sector, really the growth is really dictated by A, skill base, and B, the accessibility of the location. And this is what this chart is about. It's about how successful are locations around the country to those two dynamics. So useful to sort of identify for me when I'm picking locations, the cold spots and the hot spots. Now the second challenge, and I kind of alluded to it earlier, was around banks. And it's quite a big challenge because they are quite dominant in terms of their exposure to real estate up and down the UK. And this chart really sort of tries to identify what's going on here with the banks. And you can see some quite big exposure. This is quite a big exposure for UK banks. They're quite bloated loan books. They've started selling, as I talked about earlier, but they've only really started to really nibble into their exposures. And for lending criteria, that's got a lot tougher, and the margins have raced up. So typically, we'd be looking at 300 to 350 basis point margins now above LIBOR, and that really isn't going to diminish in the short term. Now, what does that mean? It actually means quite a lot of opportunity, and we'll come back to where we can get into exploiting that opportunity for growth in this market. Now, the other thing about banking austerity has been less development. You can see here the chart quite clearly shows that banks have been lending less to developers and developers haven't been lending. And that has done two things, and it's two advantages to real estate market. By putting a check on development, what it's able to do has been to allow conditions for landlords to potentially grow their rents within buildings without the threat of new supply coming on stream. But secondly, it's allowed an opportunity for me and other investors to really access the gap that lending has left. And I've got an example coming up where cash investors can step into real estate lending for development and get quite an attractive return. Okay, final thing from me before I hand over to Graham on some of the challenges that he sees to capturing growth is, in fact, inflation. Now, QE clearly up to 3.75, and it's looking more likely that'll grow again. And the imported inflation that we're starting to see with manufacturing shifting across to the east is actually, the combination is quite a difficult one for property. Clearly, you're experienced investors, and many of you got property within your portfolio, and you'll remember back to times when actually property was a really good hedge against inflation. That's kind of one of the great attributes of the asset class. But it isn't when the economy is in a stagnant phase. because the growth in the economy isn't driving the rents that will then generate the returns to offset the inflation. So we need some really intelligent strategies to get around inflation within property, and I highlight this chart because we do have some, so I'm going to come on to those in a short while.
So
Great.
I think Charlie's done a really good job of just summarising where we are at the moment. In terms of the recovery, it is going to affect different parts of the UK in different ways. There's very little debt available to property investors, and where it is available, it's expensive. And also, there's very limited development. And again, that creates opportunities and challenges for us as investors. Over the next couple of slides, I'm going to focus on some of the themes that we can see for property investors at the moment. Sorry, can we just go back one slide, please? Yeah, so what we have on this slide is a look at demographic change. What we're looking at here is forecasts over the 10 years between 2010 and 2020. The dark blue line showing pockets of growth in different age brackets, and the orange line is showing you expected reductions in different age brackets. And what we've tried to do here is overlay some potential opportunities for investors in property. So just looking here over on the left-hand side, we've got student accommodation below the line, so we're expecting numbers in the age bracket of 15 to 19, 20 to 24 to fall. So as investors in student accommodation, that does give us one or two concerns. Where we take some comfort here is that in 2012, university places were oversubscribed by about 160,000. We've already mentioned that in terms of new development, the pipeline's been turned off, so there isn't much new space coming on board. And also, there's still huge demand in the UK educational system from overseas students. So as a result of all that, it's not an area that causes too much concern, but obviously it's something we're monitoring. Over on the right-hand side, perhaps a more positive example, and obviously a challenge for all of us as pension managers and providers, is looking at the expected increases in age group. And in particular, one sort of stat comes to mind is that the over 80 population is going to double over the next 20 years. So I guess as investors in property, some of the opportunities we've got to look towards are things like assisted living for an older population. So just some of the themes and challenges from demographic change. Another sort of theme and trend are changes in the retail space. What we've got here on the chart is percentage of non-food sales from different types of retailer. This goes back to 2000 and projects forward to 2015. And by far the biggest change is the proportion of sales coming from the traditional high street, as shown by the green line. Expected to fall from about 70% of all sales to only 50% in 2015. And obviously that's putting a major challenge and pressure on the high street. Also, a big area of growth has been supermarket non-food sales. In particular, supermarkets are focused on things like their own clothing brands and electronics, and that's obviously seen a big increase in what they do. And I guess in a time-poor time, people like to do one-stop shopping for bigger shopping and do it all in one hit. So that's been to the supermarket's advantage. Also, of course, the big growth area, almost exponential, although not really shown on this chart, has been the rise of the internet. So virtually no sales back in 2000 and pushing towards 15%, we think, by 2015. So again, challenges for retail. And obviously where we've seen that in particular is on the high street, as I mentioned. We've seen a number of retailer failures, people like Clinton Cards, Game, Primark, one or two people really sort of suffering with this pressure on the high street. And that's obviously causing pressure and concern and failing town centres. One thing we've seen is that the average vacancy in town centres across the UK has trebled in the last 3 years. It now averages about 14.5%, which, just to get a feel for the scale of this, that's about 50,000 vacant retail units across the UK. And of course, in some markets, as Charlie showed earlier with his regional chart, more impacted than others. So some high streets now, 1 in 3 shops is vacant, and obviously that's a major challenge. Against that, though, we have seen sort of consumer backlash. There's almost been an anti-reaction to the big category killer supermarkets, and there has been an increase in appetite and demand for smaller independent retailers, and that does create opportunities. I've already mentioned online retailing, but worth just noting how that's evolved over time. Back in the early sort of mid-2000s, most of online retailing was really books and CDs. And of course, where we are today, virtually anything is available over the internet, and that does create unique challenges. And finally, sort of top-up shopping. I mentioned already that in general, people are time poor, and what we're seeing is an increase in people shopping frequently. For example, on the way to work, buying a newspaper and a packet of fags. On the way home, it's a pizza and a bottle of wine. And that is a trend that we're trying to focus on. Finally, from me in this section about challenges and themes, just looking here really at technological change. I think we all sort of behave, communicate and work differently in the era of the email. Also, of course, the Twitterverse has now taken hold, and things like video conferencing are really changing the way that we occupy space and will create challenges for office occupiers in the future. Also, again, from a lot of my clients here today, we are seeing people consolidating their office requirements, which is then putting more empty, often obsolete space back into the market, and also people are using their space more intensively, so hot desking is now quite common. Another sort of challenge from sort of technological change, but also an opportunity, is data storage. And again, this is an area of the market that we've been looking at in terms of new investment opportunities. Also within this section, it's worth talking about the environment and environmental awareness, both in terms of emissions and also in terms of efficiency. And again, Charlie's already mentioned opportunities for improving existing stock to make it more efficient. And simply put, as property investors, if your overall occupational cost is reduced, you should be able to pay a higher rent. So that's an opportunity. Also, sort of finally, just on this environmental change and emissions, it's worth focusing on transport change. And of course, people are going to be looking at how that affects us going forward.
Okay, so we've seen the list of challenges to capturing growth. It can be quite daunting. We've got weak economic growth, we've got government austerity, we've got banking austerity, we've got inflation, we've got retail spending pressures on the high street, we've got demographic change, and we've also got all of that whilst we're changing all our technologies and evolving in ways that only Kevin Fong could probably think about. So these are quite big issues for us in the property market, and for Graham and I to talk about capturing growth, clearly we've only come armed with a few of the answers today. Now, let me just talk to you about capturing growth in two ways. The first is generated growth, generated capital growth, and then I'm going to come and talk about automated income growth. So I'm going to split these two areas of growth up. Now, generated growth on the capital side seizes upon some of the themes that I've been talking about in earlier slides this morning. So let's just start talking about the entry pricing for a moment. And we saw with the banks selling down of their loan books, many of them are doing that under pressure. We know about the increasing regulation in the banking environment and Solvency II in the background and slotting in the UK. There's lots of pressures for banks to de-lever. Now, on the same basis, there's quite a number of funds and investors who hold real estate who also are under pressure to realise cash. And that's where equity holders, those that are in positive cash territory, and I would place very much pension schemes amongst that audience, have an ability to take advantage of this pressure. And this pressure obviously is producing a discounting to normal pricing. And it's that in which one can seize upon the moment and step between the gaps of those that are pressured and those that are without to then generate some very attractive entry-level pricing. And that generates capital growth. Now, the second area is around active management. And if you cast your mind back to the very first slide that I talked about, the two diverging yields for prime and secondary, the active management and the ability to actively manage real estate is actually quite an attractive and rewarding opportunity at the moment. So if we can get those secondary yields to collapse down to prime yields or closer to prime yields, the payoff is actually quite a rewarding way of generating capital growth. And I've got an example of that in a minute. Now, sustainability, we could probably have a whole morning on sustainability and what's happening in real estate, but for the purposes of capturing growth, it has a part to play. Now, obviously occupiers need and want, and they have corporate responsibilities around sustainability. And buildings need to adjust and adapt. And as owners of real estate, if you can improve those buildings in contrast to others that are available to a more sustainable and higher level of sustainability, there is the opportunity to generate rental growth. So comparative rental growth in terms of better sustainable buildings. And from our recent experience around adding income streams through some of the sustainable strategies, adding photovoltaic roof installations to generate electricity streams can also help to generate further income and further capital growth. Now, the final bit is particularly relevant for me, which is around spotting gaps in the market and then seizing upon them. And I would encourage all of you to think about that in terms of challenging strategies of your property providers, because there are multiple opportunities to stay away from the heavy weight of money that, for example, is chasing central London in trophy assets, which we think is overpriced at the moment, and really step into the areas where there isn't a lot of depth in the market. And that will come through in lot sizes, it'll come through in risk appetite. So there's quite a lot of themes going on there. Let me see if I can just bring those together with a couple of examples. The first one is around the active management and the mispricing. And this, you may not recognise this building at all, and I wouldn't expect you to, but it's a building down in Southampton, one of the insurers in that building. And it's got a short lease, had a short lease when we acquired it, 4 years remaining, good covenant, but prime building, very close to the railway station in Southampton. We acquired it for a 9% yield. Now, at that time, that equated to just over 20 million in terms of capital value. And the shortness of the lease, the lot size was manageable, but there was not a great depth of market, really driven by the risk of the shortness of the income stream. So that really drove the pricing of the yield at 9%. The vendor was pressured, it wasn't a bank in this instance, but the vendor was pressured to provide redemptions back to its unit holders, and we took advantage of that opportunity. Now, over the next 18 months, we then worked with the occupier and agreed to extend their lease to a new 16-year term. So we recreated, through actively managing that relationship, a new investment which is let to a good covenant. Fundamentally, it's a very good building, locationally, and with a skill base around it, so a good piece of real estate. And we then sold it last month to a passive investor for a 7.25% yield and a price which reflected closer to £30 million. So the uplift for us, net of the costs of re-gearing the lease, was a further £5 million. So that's quite a good example of where the market is deeper for longer income streams, play into it, change buildings around through active management, and capitalise on mispricing where investors or holders of real estate are pressured to sell. The second example for me on capturing capital growth is a building in Andover. So refer back to the development finance that I talked about earlier and the reluctance of UK banks to lend to developers. Now, even in this situation, the developer had the co-op for a 20-year lease, all signed up and ready to go, to then build out this building, but they wouldn't provide finance against it. It was very expensive because it's very much risk-off in the banking environment at the moment. So there's an opportunity there for a cash investor, and I took it. We funded this at 6.75%, So we gave the developer staged payments throughout the construction and a balloon payment when it was completed at the end to buy the investment. And it's that sort of opportunity that for me saved me £7 million or generated £7 million in value, because A, the banks weren't prepared to lend and forward fund this, and B, it was quite a large lot size and the depth of market was reasonably thin. So there's quite a lot of opportunity out there if you look for it, but look for it in particular areas. Now, I said there were two types of growth that we're particularly focused on at the moment. The second is automated income growth. And these are strategies which you'll be very familiar with that concentrate on acquisition of long-let income streams. And those income streams have fixed increases within them, or the rental payments are linked to the retail price inflation typically. And these are quite useful strategies for hedging inflation. They obviously need to make sure that the underlying financial health of the tenant is strong, but where you do have them, they're a very effective tool in managing those income streams and risks within a portfolio setting. Now, we're doing these in a number of ways, and I've got a couple of examples coming up. Sale and leasebacks are quite a popular route, so you'll find that quite a number of the corporates are engaging in that at the moment, really to work their balance sheets and generate value and cash from them. The second, and it's a really growing area that we can see coming through, is income partnerships, and there's an example of what I mean by that in a second as well. And we're particularly thinking about the alternative sectors in delivering all of that at the moment, and we hope that probably social housing is going to fall within that basket of opportunities, both from a provider but also, for me, from an investment perspective. And this is just a way of articulating how popular these strategies are becoming, and many of you will be, no doubt, invested in some of these. This is a chart that reflects the growth in the types of funds that are operating in this space of providing investors access to long hedged income exposure. And we see that continually growing. And clearly what the recent development we have seen is that with these sorts of yields trading above 200 to 300 basis points above bond yields, that actually they're forming part of the bond allocation within many of the property portfolios now for pension schemes, rather than just simply being part of the property mix. So let me give you a couple of examples just to finish off this section. I doubt whether anyone recognises where this Tesco is, because clearly they all look the same. This one is in fact in Newton Le Willows. So a good location for Tesco to be trading its supermarket from. And they put together a package, this was one of them, of supermarkets that they held freehold. So they owned the supermarket and leased it back. They sold it to us and leased it back for a period of 25 years. And within that lease, they've put clauses so that the rent will rise by a minimum of 2% per annum, but they've capped off the maximum when linked to retail price inflation of 5% per annum. So actually, when you're trying to match cash flows within a portfolio and future liabilities, you can start to see how these income streams are very, very helpful indeed. Now, I talked about income partnerships and how that was a growing part of what we do at Legal & General, and an example of where some of the opportunity lies, I think. Now, income partnerships are slightly different to a sale and leaseback insofar that at the end of the income stream, the holder of the real estate, or in this case the University Imperial College London, take back the freehold of the investment for £1. So that eventually we have a longer leasehold period, and here in the example we have a 40-year lease. So the university will sell the freehold to us, much like Tesco did, grant a 40-year lease back to us. Same arrangements with the retail price inflation linked rent, and then at the end of that period we sell it back to them for £1. And that is a way of unlocking quite a lot of opportunity, not only in this case, university accommodation, but we do see it unlocking quite a lot of opportunity for holders of real estate, local authorities around finding solutions for regeneration, social housing, affordable housing. And this is quite a big growth area, we feel, over the coming years. So there's a few growth strategies there. I know, Graham, you've got some more, and then we'll tidy up and answer some questions, I think.
Thanks, Charlie. Obviously, Charlie's given some good examples here of direct investing and ways of capturing growth. I'm now going to give you 2 or 3 examples of investing in property funds, picking out some of the themes I highlighted a little bit earlier. So firstly, obviously, we majored on changing demographics and the ageing population. And of course, I sort of highlighted earlier, the opportunity here is in assisted living for the elderly. It's got some of the attractions Charlie mentioned about automated growth, so often we have long leases with RPI. Also, it's a sector of the market where regulation is getting tougher, so there's quite a lot of older, non-purpose-built accommodation, which is almost falling out of the system, and there's demand for new stock to be built. This is where we can step into the breach in terms of providing the finance which isn't available from the banks at the moment, and really it's sort of stepping in to plug that gap. Obviously, we're aware of the austerity environment, particularly in the public sector, and where we're focused at the moment is really more on the private rented side of the market, where occupancy rates have been very high. Finally, just in terms of the overview, this is a type of investment that we like in that obviously we see demand increasing over time, and because there still are constraints on development, we're not seeing that commensurate increase in supply. So an example here of where demographic changes can be really put into play by investing in a specialist fund, investing in the senior living market. The next trend and opportunity really goes back into the retail space. And I mentioned sort of top-up shopping and how popular that's become. This is a chart from the Institute of Grocery Distributors, and what they're predicting over a 5-year period to 2015 is about a 1/3 increase in convenience retail sales. So this phenomena of top-up shopping. On the next page, I'm going to talk about how we capture this as investors in property funds. What we've done in this instance is actually create a property fund around an external manager who specialises purely in this space. So it's almost a traditional corner shop. We're really picking up on these trends in customer behaviour. And again, we've got these similar themes of automated growth coming through. Here, very strong covenants, long leases, and annual RPI increases, giving us a certainty of income growth over time, which we can offset against rising inflation. Also, it's key that here the rents are affordable. On average, across the UK, passing rents are between about £6 and £20 per square foot. Putting that into a context, offices in the West End of London currently, the prime offices are rented at over £100 per square foot. Supermarkets, certainly in the southeast, are pushing £30 per square foot. So very affordable. Also, as part of our due diligence, looking at the turnover of these stores, the annual passing rent is about 5% of their total turnover, so very affordable, and that should give us potential to grow rental value over time. Also very key here is retailer pricing power, and one thing that's apparent from this is that retailers are able to pass on rising commodity inflation onto the customer. The customer will pay for this convenience, and that's really demonstrated by the fact that the average cost of goods in these stores is about 14% higher than it would be in the supermarkets, but people are prepared to pay for that convenience. Finally, there are opportunities here also for generated growth and added value. Again, there are development opportunities, whereas cash providers, that gives opportunity. Also, we can change planning to create opportunities, and quite often there are upper parts on these properties which either can be let out as offices or residential, again to create higher value and just to give us a greater yield. The final example from me is going to be focusing on technological and environmental change. Now, for anybody in the audience under the age of about 40, the gentleman in the top right-hand corner is Arthur Daly, often seen sporting a very nice sheepskin jacket. And just to sort of coin a phrase from Arthur, we think this could be a nice little earner. What we're looking at here is car showrooms. Not the most obvious thing to invest in, but we think it's an emerging area for institutional investors in property. What it does provide is protection against online retailing. What we found is that people, when they're spending larger amounts of money, so bigger ticket purchases, they physically want to go and see what they're buying. And of course, if you're buying a car, you want to test drive it. So that does give you some protection from online sales. Again, it's got these characteristics of long leases and RPI. And again, it's very important to know that these rents are affordable. Again, in our due diligence, just purely looking at the servicing revenue, that more than covers the rent from these sites. And of course, we're then less dependent on new car sales, so less dependent on what's going on in the economy. It also does play into technological change. So of course, there's a focus on efficiency and emissions. So we think over time, people will be encouraged to buy new cars, which are more energy efficient. And of course, as the cars get more sophisticated, people are going to have to take them back to the dealers to get them serviced. So again, that just underpins these sites as very important locations. The final point here is that, again, as a real asset class, one of the underpinning values of this type of investment is often a change of use. So if it's possible to get a change of use either for retail or residential, that can also create extra value for our investors. So really, the final slide of our presentation, really, and summarising here and looking a little bit forward, obviously we know that the short-term outlook is very challenging. It's a stagnant economy, but there are opportunities for investors, particularly in property. Income is very important. We've already mentioned the fact that income yields are pushing towards 6.5%, and our forecasts indicate that over the next 5 years, income will be about 90% of the return from property. So making sure that you have a generous income and a secure income is very important. Growth is achievable, but we think that's only going to be in very certain parts of the market and certain pockets. And of course, looking at individual property strategies as Charlie outlined. And also, finally, we do think there are opportunities at the moment for cash investors, particularly when banks aren't providing that liquidity. And that really does create investment opportunities for all of you here in the room today. That's the end of the formal part of our presentation, but obviously welcome any questions you might have for us.
All right, thank you both very much for a very clear presentation. So we've got a bit of time, plenty of time for questions if you want to follow up. Please, over here. Could you just say who you are again when you ask your question, and perhaps indicate who you would like to ask the question of?
My name is Mary Blatchford. I'm a North Somerset councillor. I'm also a member of the Avon Pension Fund. As a member of the Avon Pension Fund, I'm very pleased that the returns on property investments. However, as a North Somerset councillor, which is a seaside council, I'm very concerned about the large size of care homes and residential homes because, quite frankly, most people can't afford them for more than 2 years when they live in them, and we have to pick up the tab. So don't you think it might be a bit better if we had smaller care homes? Because I am rather concerned on that area.
I'll take that question. Yeah, it's a very good point. And again, it's down to the underlying real estate and making sure it's the right property in the right location. And again, it comes down to supply and demand and making sure that markets aren't oversupplied. Obviously, when we're investing in this area, it's with external managers who are experts. And of course, they're doing a lot of work in terms of the catchment area and affordability. But it's a very, very fair point.
Okay. Anybody else? I think you must have shocked them into silence. I don't know. Nobody's going to buy a BMW dealership then. Over here, yeah.
Just because of the economic
Could you use the
which
mic?
we find ourselves in. Do you see an end to these upward-only rent reviews, which we've been used to in the UK, but which I believe are not necessarily the case in other parts of Europe? And if that should happen, what would the impact of that be on the property market?
John?
It's a very, very good question. Quite rightly say that upward-only rent reviews have been within our investment landscape and the property letting landscape for very, very many years. I think what we have seen is some attempts to legislate against it and force landlords into more flexible tenant arrangements. But actually the market is coming round to the way that, because of the changing nature of occupation amongst many tenants, and this is particularly relevant for office occupiers, business shape tends to take a lot of change over the leasing period. So what occupiers are now looking at is, rather than signing up for longer leases, we've seen the incidence of shorter leases come to the fore, which really gives an opportunity to reset the market level at the end of each of those leases, rather than seeing upward-only rent reviews being the difficult area. And I think you're quite right to say that on the continent, this has been really the norm for many, many years. In fact, the UK is really the only market that has the prevalence of these longer leases with upwards-only rent reviews. So I think probably rather than seeing upwards-only rent reviews being the difficulty, I think we're now seeing a very much changed environment to shorter leases, which do away with the rent review clause altogether.
Okay. Nobody else? Well, I think we'll draw it to a close then if there are no more questions. I think you've given a very clear exposition of the value of property, particularly in the long term.